Welcome to this explainer. Look, if you spend any time at all watching the crypto market, you already know it is an absolute roller coaster. It's so easy to get swept up in the hype, right? You watch some random coin rocket to the moon, and that fear of missing out hits you hard. But buying in just based on hype, honestly, that is a really dangerous game. It's basically just gambling. But today, we're going to fix that. We are going to learn how to systematically evaluate digital assets so you aren't just guessing anymore, but actually investing with a clear, logical strategy. So, that brings us to literally the million-dollar question, doesn't it? How do you actually separate the genuinely good crypto investments from the absolute bad ones? Well, the answer is deep, methodical analysis. This is going to be your ultimate tool to save yourself from those risky gambles and help you avoid the projects that are practically guaranteed to fail. Okay, let's dive into this. Here is our roadmap for today. We're going to start with the basics of coin analysis, move into fundamental analysis to find real value, then hit technical analysis for reading charts, have a little showdown between FA and TA, and finally, give you your ultimate analysis checklist.
All right, Section 1, the basics of coin analysis. Let's set the foundation.
To truly master cryptocurrency analysis, you have to understand that there are two distinct halves to this equation. A lot of amateur investors just pick one side, but you really can't rely on a single perspective. On the one hand, you have fundamental analysis, or FA. This asks the big question, what is the coin actually worth? And it anchors us in reality. On the other hand, you have technical analysis, or TA. This asks, where's the price going? It focuses entirely on market timing and price action. For sure, you absolutely need both if you want to be successful.
Moving on to Section 2, fundamental analysis, uncovering real value.
So, fundamental analysis is all about looking under the hood. Let's calibrate your radar for green lights and red flags. First up, the white paper. A huge green light is when it clearly explains the specific problem the project solves. But if it's vague or looks copy-pasted, just run away. Next is the team. Verified experience is what you want, but an anonymous, unknown team? That means there's zero accountability if the project tanks, which is a classic setup for a rug pull. Finally, the coin has to have a real-world use case and actual demand. If there's no clear use case, that is a massive red flag. To really ground this concept in reality, let's look at some strong examples. Bitcoin essentially acts as digital gold, a store of value. Ethereum powers smart contracts. You can think of them like digital vending machines that just execute automatically when certain conditions are met. Then there's Chainlink, which brings real-world data like weather or stock prices right onto the blockchain as an oracle. And Solana is built specifically for incredibly fast and cheap transactions. The point is, every single successful coin needs a very specific job. All right, let's talk tokenomics. It's exactly what it sounds like, token plus economics. You want a limited total supply to protect your value, not some unlimited inflation that just eats away at it. As for distribution, the coins need to be fairly spread out. If the developers hold 80% or more, yeah, that's a trap waiting to be sprung. You also want to look for a long vesting period where the team's tokens are locked up. And finally, a mechanism where coins are regularly burned is fantastic for driving scarcity, whereas having no burn mechanism can quickly flood the market. Let's move on to size and risk. Market cap is just the current price multiplied by the total circulating supply, and this directly correlates to your risk level as an investor. Microcaps, anything under $100 million, are incredibly high risk. And it's not just about their size, it's about liquidity. Low market depth makes these microcaps super easy for whales to manipulate. Small and mid-caps scale up to medium risk, and once you cross that $10 billion mark, you're looking at large cap coins, which are generally the lowest risk threshold in the whole crypto space. Now, what's really interesting about this slide is what happens when you apply this exact math to the top of the market. The numbers are just staggering. Let's calculate Bitcoin's market cap for a second. If the price is $60,000 and the circulating supply is 19.5 million coins, you multiply those together and bam, you get $1.17 trillion. That is the ultimate definition of a low-risk, large-cap asset. Let's move to and see how this builds into Section 3, technical analysis and reading charts. Okay, so we've figured out what a coin is worth. Now we need to predict where the price might actually go next. Every single candlestick on a chart tells a story. We all know green means up and red means down, right? But the real insight is in the wicks, those thin little lines at the top and bottom. Insightful traders look at wicks to read market psychology. For example, a really long top wick tells us that buyers pushed the price up, but then got completely exhausted and overwhelmed by sellers who drove it right back down. That's exactly the kind of psychological clue you need to spot. Next up is support and resistance. Think of price action like a rubber ball trapped inside a room. Support is the floor where the ball just keeps bouncing up from, like Bitcoin hitting a rock-solid floor at $60,000. Resistance is the ceiling where the ball hits and gets rejected back down, like repeatedly failing to break past $70,000. The ball's going to bounce between these levels until it finally breaks out. So your basic strategy? Buy near that support floor and sell near the resistance ceiling. Then we have moving averages. These smooth out all that choppy, chaotic price data to show us the overall trend. The MA50 tracks the short-term trend over 50 days, while the MA200 tracks the long-term trend over 200 days. Now, when the 50-day average crosses above the 200, that's called a golden cross, and it's a highly bullish signal. But if the 50 crosses below the 200, well, that's the death cross. Very dramatic name, I know, but it's a major bearish signal. Another great tool in your belt is the RSI, or Relative Strength Index. Think of it like a momentum thermometer that scales from 0 to 100. If the RSI is above 70, the coin is running way too hot. It's overbought, and the price might drop soon. Between 30 and 70, that's neutral territory. But if it dips below 30, the thermometer is freezing. It's oversold, which signals that the price could bounce back up soon. To wrap up the TA side, we look at the MACD to spot trend changes, but honestly, even more importantly, we look at trading volume. Why does volume matter so much? Because high volume represents conviction. It proves that institutional money is actually backing the move, making it legitimate. If the price shoots up on low volume, that is just a weak, retail-driven move that could reverse on you in a heartbeat. The golden rule? Always confirm your price moves with volume. Which brings us to Section 4, FA versus TA, the showdown. So the crucial point is this. They answer two completely different questions. Fundamental analysis focuses on real value for long-term investors, asking, is this coin even worth buying? Meanwhile, technical analysis focuses on price charts for short to medium-term traders, asking, when exactly should I buy or sell? Amateurs usually feel like they have to pick a side, but the pros recognize that these are just two halves of the exact same trade. Finally, Section 5. Your ultimate analysis checklist. Let's put it all together. True analysts frame all of this as one complete, seamless workflow. First, you zoom out, clear the white paper, vet the team, check the tokenomics, the market cap, and the community. Only when a coin actually survives that fundamental gauntlet do you zoom in on the charts. That's when you start finding your support floors, weeding the RSI, checking your moving averages, and waiting for that all-important volume confirmation. Now, to actually execute this workflow, you need the right tools. Use CoinMarketCap or CoinGecko for your market cap, price, and volume data. Then jump over to TradingView for all your advanced charting and technical indicators. If you need some deep fundamental research, head over to Messari. And for on-chain analytics, tracking the actual raw network data, Glassnode is absolutely going to be your best friend. Which leaves us with this absolutely crucial takeaway directly from our source material. Never buy a coin based on hype alone. Always do your own research and analyze properly. We've built your analytical toolkit today. We've shown you how to measure real value and effectively time the charts. So I'm going to leave you with this. Log into your exchange right now and take a hard look at your portfolio. Are you holding meticulously researched assets with clear utility and volume? Or are you just holding on to somebody else's hype?